I'm Dean Miller, the President and CEO of PACT, and I want to welcome you to our PACT CEO SaaS Roundtable, where we're going to get into some interesting discussion and a dynamic one. So start getting your questions ready early. More on that just in a second. We are grateful and thankful for so many great supporters of all that happens in this region around enterprise technology, and particularly the SaaS market, and want to thank our sponsors, Boomi, Cigniti, ORS Partners, SAP, SEI, and Troutman Pepper. I mentioned that we're going to take a different approach this morning, where we're going to engage the attendees. Now, stay muted, but we really want to have a dialogue this morning, and our panelists and our moderator are going to expertly involve your questions and input throughout this session. And so just stay active, and again, post your questions in chat, but also, again, we're going to make sure that we do everything to engage you in the dialogue throughout this process. Without further ado, I would like to introduce our moderator, who's no stranger to this world, Chris Miller, a longtime PACT board member, office managing partner at Troutman Pepper, and someone who works with countless companies in the SaaS space, and certainly dedicated to supporting that sector of our growth economy. So welcome, Chris.
Thanks, Dean, and good to be with you all. We've got a really good panel today, some experts in this area, and I think this is going to be a very good discussion. As Dean said, we want to make this as interactive as possible. So if you have questions along the way, please don't hesitate to post them. We would love to make this into a dialogue if possible. And I know Dean just said to stay muted, but if this becomes something more of an interactive session, that's fine too. I think if we can have everyone engaged, we want to make this as relevant as possible to everyone. So let's introduce our panel. I'll let each of the panelists introduce themselves. Bob, why don't we start with you?
Sure. Bob Yayac, I'm the owner of BizDev Consulting. We do growth strategy consulting for technology companies.
Brian?
Brian Kim, I'm a partner with NewSpring Capital's growth equity strategy. NewSpring Capital is a lower mid-market private equity firm that invests across technology, healthcare, mezzanine debt, as well as controlled buyouts.
Great. And Soma.
Hi, good morning. I'm Soma. I'm the CTO and president at a company called Infor. We're headquartered out of Manhattan. I'm actually in the Philly area. The company grew from this region, and we're in the business. We're in the same business as SAP, Oracle, in terms of enterprise applications. SaaS company that grew from fairly nothing to $1 billion of SaaS. So that's Infor.
Great. So we're here to talk about TAM. TAM is certainly a subject that there's some mystery around, some confusion at times. I've certainly sat in a lot of boardrooms of companies, both before and after being financed and and preparing for acquisitions, where the concept has been batted around, and very clear that not everyone fully understands it and certainly doesn't always agree on how it's used. And so we're here to have a really good discussion about TAM and how it might be relevant to your business and how you might use it in a variety of ways. So why don't we kind of start with some basics, though? We've got some questions that we'd like to use to gauge audience experience in this area. So Heidi, why don't we start with our first question, and then if everyone can respond to it, we can kind of gauge what everyone's current state of knowledge is. Okay. So tell us, to the best of your understanding of the available choices, what does TAM stand for? And Heidi, let us know when we've got everyone's answers recorded, and then we can show what the audience consensus was. Okay, looks like we've got a relatively experienced audience. So we're not starting from scratch today, which is actually a good thing. That's fantastic. So Bob, why don't we take a second, even though we've got a relatively experienced and sophisticated audience who seems to know at least what the letters TAM stand for. Why don't we talk about it a little bit? Because I'm sure there might be not a consensus of opinion as to exactly what total addressable market actually means.
Yes, thanks, Chris. Yeah, so we now know everyone is in the correct session as well. I think the television audience measurement is coming up later in the program, but great that everyone's here, and great that everyone has a good understanding of what the concept of TAM is. So maybe just a quick definition, if you will. We'll get into a lot more details as we get into the conversation, and probably more importantly, we'll get into the value and why we would use a TAM. So a TAM, the total addressable market, is really in some ways also a theoretical addressable market, because it is the theoretical revenue that you might get from 100% market share of your product service. So if everyone in your market adopts and you've got a price point at a certain level, the quick math gives you a TAM. And it is very theoretical, because we're never going to get 100% of our market share, but that would be a starting point for a lot of the conversation. So it is a big number. In many cases, we'll talk about it a lot more, and how you do that, how you calculate it, and how you use it. But I think that's a pretty good starting point. So Chris, maybe we'll get to the next couple of questions.
Terrific. Heidi, why don't we post our second question and kind of get into some of the audience's actual experience with TAM. So for each of you and your company, have you developed a TAM? Have you been asked, but you haven't yet? Or are you confused as to the value and have not even had an interest in developing one? Okay, so we've got a relatively even mix between those that have developed a TAM already and those that have not, either because they've been asked and haven't gotten to it, or haven't been able to yet, or have not seen the need, or are confused as to the value of it. So why don't we do one more question? Because for those that have either developed it or have been asked, I think the next question really gets to the heart of what we're going to be discussing today. So Heidi, why don't we go ahead and do the third question? So for those of you that have either actually developed a TAM, or those that have been asked but have not actually done so yet, what was the purpose behind it? Is it for securing growth financing, selling the company, going public, just informing your business strategy, or some other reason? And as you'll see, as you're answering this question, this is really the meat of what we want to talk about today, not just an informational session on what TAM is, but really an understanding of how it's used. Well, that's fantastic. It's good to see those results. So a good chunk of the audience has used it for the purpose of securing financing, and then another chunk has used it for the purpose of informing a business strategy. And maybe we rigged it a little bit insofar as only allowing you to answer one of the choices, as opposed to being able to select more than one. So it's going to be, what we want to discuss today really is whether TAM is something that is used solely for purposes of a transaction, choices A, B, or C, or whether it's something that typical company is using in its ordinary course development of business strategy. But because it looks like the audience's experience, Brian, has been predominantly in the area, at least significantly in the area of securing growth financing, and that's an area near and dear to your heart. Why don't we talk a little bit about what you look at, both in terms, let's start with what, as an investor, what you're looking at in context of assessing and evaluating a potential investment, and then we can roll over into how it's used by your portfolio companies post-investment.
Sure. So within the context of market size and TAM, I'd say, we really look at it across a few different fronts. I mean, first and foremost is really when we first get to know a new company and a business model. It's a factor that impacts our views in terms of future growth. How long is the growth of the company going to sustain today? How much room is there in their market to grow going forward? And essentially, at the end of the day, it's something that ultimately impacts valuation as well on the companies that we evaluate. Because of course, at the end of the day, revenue growth and scalability is ultimately the biggest driver of returns for our type of investment model. We also look at kind of TAM very continuously post-investment, both at the board level, but also on exit. On exit, new investors or acquirers are going to be thinking about the very same questions we thought about 3, 4, 5, 6 years prior. And so it's something that we continually want to refine, evaluate, expand, and kind of build the business and drive the business that maps to, I think, those factors. Going in, and I think from a diligence standpoint, we certainly want to gain a lot of comfort that the market opportunity is big, that the problem a company is solving for is not just a difficult problem to solve for, but a problem that many, many potential customers out in the market have. And some of the ways in which we really scrutinize TAM is, as opposed to just accepting a number that's given to us by a company, we spend a significant portion of our diligence scrutinizing that number. We will triangulate, cross-reference. We will go from top-down methodologies to estimate market size, as well as bottoms-up approaches, and really peel back the many layers of the onion there to get a better understanding of where is that TAM, how accessible are each kind of layers of that TAM, geography, market size, customer size, and so forth. And it ultimately ends up being, I would say probably at least like half the focus of the team here when we're getting to know a company.
So in evaluating a particular investment and the company's TAM, do you ever disagree with the company as to exactly what the market is? Is there some, especially in this SaaS world, with the companies that you're looking at, is there ever kind of a disagreement up front as to what the market really is that's being addressed?
Almost always some level of disagreement, and not because I think methodologies are flawed or anything like that, but we always view, addressable is a very loose term to begin with. And so for us, it's not so much about there being a right or a wrong number, whether it's 2 billion or 4 billion or 4.5 billion. It's more about trying to get to that level of granularity to understand what are the ranges and how should we understand, I think, the market itself, the different pockets of that market, how to actually go about executing against those different pockets. Where should we focus our time? We tend to think of things, I think one helpful way we oftentimes think about opportunities is, it's a big landscape. And what are the hills inside of that landscape that you want to climb up, conquer, and ultimately plant your flag on? And you could argue that the whole landscape is your TAM. You would be correct. You could also argue that, based on your particular platform, your particular feature set today, or a variety of other factors like adoption rate in the market, that at least in the next 2 to 3 year period, this hill or two is really, I think, the TAM that you should focus on. So it is not necessarily something we view as kind of being a binary, not like a right or a wrong, but that process of going through and scrutinizing that number is really something that we find tremendously valuable.
Got it. So first, up front, you're assessing TAM in the context of making your investment. And now you've made your investment, you're on the board, the company is executing on its strategy. Talk to us a little bit about how TAM is used in that process, and whether A, TAM evolves over time based on the company's development, and B, is it utilized generally for purposes of executing on the business strategy in and of itself, or is it always in the context of the ultimate exit and what you're trying to accomplish on the back end, given that you guys are investors, obviously, with an expectation of an exit at some point in time?
Yeah, it's a great question. I mean, the short answer is really both come into play continuously. We always think about company positioning in the market and how that's viewed on an exit, even throughout kind of the life cycle of an investment, even early on when we have no plans to exit. And ultimately, at the end of the day, I think TAM, when we think about market opportunity, part of the reason why it's really important is because we view that as being a ceiling to growth. And so when we're on the board of companies and if their TAM is limited, or the company has scaled so well where in relation to the company's scale, the TAM is limited, we view that as being a potential limiter to growth. That extra 10% of market share is going to be that much harder. The greenfield opportunity in that market is going to be even less. And so part of what factors into, or how we factor TAM into some of our operating decisions are really, what is that trade-off between growth and profitability? If the TAM is limited or saturated, I think oftentimes, the business strategy going forward tends to prioritize profitability more than growth, because the growth ends up being less efficient of an investment. And I think for that reason, it's something we continually monitor. And for a lot of our companies that are in smaller TAMs, but quickly growing TAMs, we want to constantly evaluate that and figure out, where do we invest more? How can we unlock additional TAM? Whether it's through R&D investments, acquisitions, or other decisions.
Great. So let's elaborate just a little bit more on that growth versus profitability question, because that's probably something that members of our audience are grappling with right now. So how to explain a little bit more about how TAM factors into that. And really, I got to believe that that's all focused on the ultimate exit, right? Trying to either maximize growth because you're going to be evaluated on that measurement tool ultimately by the ultimate buyer, or you're trying to maximize profitability because you're trying to be bought based on some sort of a EBITDA metric as opposed to necessarily a revenue multiple. So can you dig into that a little bit deeper, because there's no question that members of the audience are going to be thinking about that with respect to their own businesses.
Yeah, sure. Well, so, and this is at least kind of the framework or general direction in terms of how we think about things, especially growth versus profitability in light of market size. So for us, generally, I think when we see companies that are pursuing a market opportunity, but the market opportunity is limited in scale, that for us tends to influence how we view how much the company should raise. You could be a company that's has a great product market fit, but limited TAM for that product. And those can be terrific opportunities, but when we look at opportunities like that and business models like that, those tend to be opportunities that we would encourage those companies to raise less as opposed to more, and in some cases even encourage them to bootstrap their way to that market opportunity as opposed to take on venture capital or growth equity. I think in terms of that trade-off between profitability versus growth, when you have a larger TAM, part of the reason why, if the TAM is large, not saturated, and in a lot of our businesses cases, they tend to be greenfield. These are quickly emerging and burgeoning areas of spend. A lot of those, the growth tends to be fairly efficient. And so I don't want to use the term land grab, but there's a wide open landscape for sales and marketing to kind of go out, reach prospects, find customers, and land new relationships. If the saturation of the market tends to run out or tends to get to a point where you see that efficiency drop back, I think companies generally have two ways of navigating that dynamic, which happens to every single market over time. And one would be you deploy capital investment to invest in other areas, either through product development or M&A to expand into other areas where you grow your addressable market and find other opportunities where that growth will come easier. Or you can stop spending as much and investing as much in that high growth phase and start to prioritize profitability, especially when it ends up being more of a crowded market. So not sure if that answers the question, Chris, but it's at least a flavor of how we tend to look at things.
Great. Well, I think that's also a natural segue, Soma, into how you, as a buyer in the SaaS market, look at TAM when assessing a potential acquisition opportunity. So why don't we start there? Now that Brian's talked to us a little bit about how they assess their investments and help their companies along the way toward a potential exit, now they're looking to the Infors of the world as the buyers of their portfolio companies. So let's talk about the perspective of the buyer. How do you view TAM, and how do you use it in assessing acquisition opportunities?
Yeah, I mean, I'll piggyback on what Brian said. So if you look at from an acquirer standpoint, when you look at TAM, I kind of, the way I look at it is, one, the industry that is being served. That is actually a little bit tricky, how you define what industry you're serving and what business you're in, right? So that determines sort of how big the market is. The second is what region you're in. Some companies tend to be global, some companies tend to be regional. That defines the marketability of the product. So there are characteristics of the product that make it suitable for a global audience versus regional audience. So geography, it plays a role. 3 is pricing power. So pricing power has got a lot underneath it, meaning it depends on what's your competitive advantage. Are you, if it's greenfield, you're uniquely positioned, then obviously there is, to use Brian's term, land grab. You can go attack a market, there is not much competition, versus you're in a crowded market where the opportunity is not as great as in a greenfield. So looking at those, if I just take those 3 metrics in terms of how we look at what is realistic in terms of TAM that is achievable. That is how we determine, in terms of, the buyer as we are cash rich. We're owned by Koch Industries. You got, $10+ billion of cash. So if you have a lot more opportunity to really drive the growth engine, that is attractive from my point of view, right? On the other hand, if it is already a saturated market, just throwing money at it doesn't necessarily help, because you're competing on a, pricing power is less in that scenario. So that's how we look at it when we're looking at acquisitions. So just to sum it up, it's industry, it is geography, and it's pricing power, which has competition in it. That's sort of how I look at it.
Got it. So is the basic message, though, that it's not a question of you only look at businesses with a really large TAM. It's just about how the business is operating relative to its TAM. Is that the right message that we're trying to send?
Exactly. Yeah, exactly. I mean, TAM, you start with a theoretical TAM, which is, generally tends to be very large. Then you sort of look at it more carefully in terms of what is really the TAM that actually a particular company can go after and achieve, right? So that's, yeah, exactly right. That's how we look at it.
So I asked this question of Brian earlier, is there often disagreement between you as the buyer assessing an opportunity versus how the company and its investment bankers are marketing it? And is there a gap that needs to be bridged between your assessment of the market versus the company's assessment of the market?
Yeah, like Brian said, almost always, right? So when the seller is positioning the product, obviously they want to be more generous in terms of what the total addressable market is, and that's natural. Like so you're aspirational. You're trying to get to a much broader market. As an acquirer, the view is you have to sort of be grounded in terms of what is realistic to achieve. So in that scenario, there is always a gap between what the seller thinks the market is versus what the buyer thinks what's actually addressable. And so the only way to sort of get to some level of consensus is to double click and go to the details, like I was saying. So you map it out to see really, it's sort of like, we're in industry specific software. So just to use an analogy, if somebody says that I'm after food and beverage industry, right? That's a big sector of the economy, right? But if you really look into the product and what they're actually trying to address, maybe they're only in solving, breweries, but that's a much narrower market than a food and beverage market. So that's sort of how the gap needs to be narrowed, by looking at what's achievable and what the real competitive differentiation is. And that creates focus, and actually you can capitalize on the TAM that's available and win market share.
Terrific. So we've got a question from the audience, and I'll address this to Soma and Brian and see if you can answer it. The question is, what threshold of TAM would be considered too small for a company to need to think about profitability rather than growth? So Brian, you talked about that, and Soma, you did as well, in terms of assessing whether the TAM is going to dictate or at least influence whether the company should be focusing on profitability rather than growth. That in the context of a large TAM, growth is probably going to be the primary factor. So can you talk to us a little bit about what that means? How large is large enough to be focused on growth? And obviously there's going to be differences in terms of what markets, what companies, what businesses we're talking about, but do we have a general assessment? Soma, why don't we start with you? If you're looking at an acquisition target, what numbers are you thinking of in terms of what you would assess for purposes of growth versus profitability?
Yeah, if it is, for us being, the size we are, generally, if the addressable market is less than $1 billion, then it is not very attractive, because you're looking at it over a longer period of time, over the next 10 years. And if the market is too small, you're going to plateau very soon, right? So the market has to be, in terms of multiple billions of dollars for us to be interested in it. And the second thing is how much has been captured in the market, right? So including the competition. If there is enough of the market that is open for capture, that's also a metric that we look at.
Got it. Hey, Brian, why don't we circle back to you and answer the same question in terms of your assessment of a potential investment opportunity? how are you measuring? What's the size that where you would focus on profitability rather than growth?
Yeah, so if I may, I would actually tweak the question slightly.
Please do.
Because I think Soma's point is probably the most important point, which is it's not so much about the TAM being large or small, or the spend in that market currently being large or small. It's more about how much of that market opportunity has already been captured. And if a large portion of that market opportunity has been captured, it's starting to get saturated, then that's kind of when we would encourage, at least for that segment, more of a prioritization on profitability and less of a prioritization on growth. In terms of how we view this as an investor and as a growth stage investor, for us, we tend to look for addressable market opportunities at least at 500 million and above. They tend to be, on average, multiple billions of addressable market opportunity, but as a minimum cutoff at about 500 million and above. And what I would say is, with companies that are currently going after TAMs at around 500 million or even smaller, it's not so much about should you be profitable or should you be growing, have a growth strategy. It's more about how much capital should it take and how much capital should you plan on being able to raise to go after a market opportunity that's 200 million or 2 billion. If the market opportunity that is wide open right in front of you is 2 billion, raising a couple $100 million along the way to capture that market opportunity makes a ton of sense. If the market opportunity that you're going after, it could be a wonderful market opportunity and a highly profitable one. If that market opportunity is a couple $100 million, you probably shouldn't plan on raising a couple $100 million to capture that. It ends up being much more difficult both to raise the capital, but much more difficult to deliver a return, to shareholders and everybody involved along the journey if that's the limiter of the opportunity.
Got it. And so NewSpring, as a growth investor, has what you mentioned, a 500 million, but more likely in the $1 billion TAM. I'm sure that there are earlier stage venture investors, more traditional venture investors that don't necessarily need to have a TAM that large. Is it your understanding, given your obviously experience in the kind of full spectrum from early stage seed investors, venture on up, that there are investors who are interested in companies with smaller TAMs, but still have an opportunity to put in a smaller amount of capital in order to maximize that investment potential?
Yeah, I would, to me, it almost feels, just based on my interactions with earlier stage investors, and especially on the venture side, that you almost have the opposite dynamic. So early stage investors and venture firms, part of their model, and this is very generically speaking, their portfolio strategy is much more where they have to sprinkle a lot of dollars across a lot of companies, and in the hopes that a small fraction of those make it very, very, very big. And I think because that is their model to blend out to overall fund level returns, they need to make sure that they're placing bets across a number of companies, each of which has the opportunity to actually get to a multiple billion-dollar outcome. And so for that reason, I would say that, at least the way I think about the underwriting approach for earlier stage investors, TAM becomes even more important, if not one of the most important factors that they look at when they underwrite a company. For NewSpring itself, we tend to take a fairly different approach because we're later stage. These are established companies. We tend to take a slightly different approach where, if we're investing in 12 companies, our expectation and the way we construct that portfolio is that all of those companies, will generate a healthy outcome. And Bruce has a wonderful point here where good VCs, I agree, good VCs do not sprinkle dollars. But
Bruce took exception to your term sprinkle.
you're absolutely right.
Touche, Bruce.
Yes. But I'd say for later stage opportunities, there's a lot more that's defined in terms of kind of the market spend and everything else. And I would say, the ability to actually underwrite companies that have limited TAM exists in a different way. And again, I think for that, we would start to focus on how much capital should we raise to kind of go after a $500 million market opportunity versus one that might be going after like a $5 billion market opportunity.
Got it. Okay, well, now that he's entered the fray, Mr. Lures, let's go off mute and if you can, give us your perspective on how you look at TAM and assessing your potential investment opportunities. Are you there? Can we get Mr. Lures off of mute?
I don't know. Can you hear me?
We can hear you, Bruce. Fantastic.
geez.
Good morning. Good morning and welcome to the conversation.
Hey, good morning, guys. Great stuff. I guess I'd throw in, if it's a dialogue here, I'd throw in an early stage perspective, which is you were often betting that the TAM gets a lot bigger. You want to get into a growing market. So, if we knew for sure it was $1 billion TAM, then the smart guys and the big money could jump in. But we're betting on all the other elements. But we're looking at niches and hoping that those niches actually expand into something bigger. So it's just another reason early stage is risky and why we have to sprinkle a lot. No, we have to invest in a number of companies.
So, Bruce, do you ever decide not to make an investment into a particular company, either solely or predominantly based on its TAM not being large enough?
Yeah, I guess if I can be useful there. I mean, a lot of times markets are emerging. Telemedicine, I'll just pick an example. I mean, I think everybody on the panel and, everybody's been thinking about telemedicine for 3 decades. It just didn't emerge. And I think finally, unfortunately, but COVID had a profound impact that, it had to clear the deck, so to speak, on regulatory constraints and reimbursement constraints. So if I'm making a point here, it's that, markets evolve differently at different rates. We've all seen these curves of how adoption went from cable to TV to iPads, and so we're not smart enough to know how quickly they emerge. But we're making some macro bets along the way. But the other dimension I'd be interested in the panel is okay, it's $1 billion TAM. What's a realistic goal for market share? I mean, God loves a monopoly if you own it, but it's rare that you're going to capture 60% of a market. So, what is market leadership in $1 billion TAM? At 2%, 5%, you're almost destined to be a third tier provider, which doesn't get a premium. So that's part of the calculus, I guess. But I wonder how you guys think about how to become a market leader in a $1 billion market.
Well, that's actually a great segue, Bob, isn't it, into our final question?
I think it is, yes. Do you want to?
I think it is. So, Bruce,
I always
you
like to
might
tee up Bob. Go ahead, Bob.
Thank you, Bruce.
I'll tell you, Bruce,
that.
you're terrific. Why don't we, Heidi? Why don't we throw up our last question and get our audience response, and then Bob can educate us a little bit about what Bruce was just alluding to. So we've got some new acronyms, SAM and SOM. Some may know what those mean and some may not. Some may have used them and others may have no clue. So why don't we get our audience's reaction, and then Bob can educate everyone on not just the meaning, but really, to Bruce's point, how it's utilized. As you're putting in your choices, please remember that we can answer questions as posed on the chat room. So I think somebody actually did pose this earlier.
Yes.
So thanks for that. So we've got some SAMs and SOMs. So Bob, why don't you take it and give us a little bit of an insight into what SAM and SOM mean and how they
Sure.
can be used perhaps even more effectively than the TAM itself.
Definitely. Well, thanks, Chris. And Bruce, thanks for the segue into this. So really kind of building upon what Brian and Soma were talking about. TAM is a important number, but really, if we're going to use it for decision making, we really need to go beyond that, because you're going to get asked a lot of questions about your TAM, and if you haven't really thought about it and developed it in a kind of a rigorous way, you're not going to be able to answer those questions. So I think what both Brian and Soma talked about is really probably the first question you're going to get is, what is that customer need that you're addressing? That's probably the most critical question that you're going to get asked, and you really need to be able to understand that. So oftentimes when we're building TAMs, we're using different models to try to understand what those needs are. And the very familiar one is one called Jobs to be Done, where we're looking at what is important to the organization or the market, but not well satisfied. So we're really trying to find those gaps in the market that we can go address. And obviously we're looking both today, but where those are going in the future. So are things going to become more or less important, more or less satisfied? Great opportunity to really understand what that need is. But maybe just starting with TAM before we get to SAM and SOM a little bit, Brian and some of us talked about this, is really kind of what is your unit of measure, if we want to start there. Is it number of companies in a market? Is it number of users, number of vehicles, number of purchases? Like, what are you going to use to really try to start calculating your TAM? So we need to understand that unit of measure. We need to understand the segments that might be accessible to us, as someone was talking about. And we have got a pricing idea of what we think we're going to charge for that unit of measure. So in some ways, TAM is relatively easy to calculate. It's really just understanding what is that need and how we're going to calculate the unit of measure and go from there. And I think Brian also mentioned, it's an estimate. So, adding 3 decimal points to your $3 billion TAM is probably not helpful. No one's going to believe it anyways. It's 3 billion plus or minus. So, we spent a little bit of time looking at this, but really the TAM, the most important part, I think, for the work we do is really digging into that customer need and really understanding what are we doing there and why is this unique or valuable. And just to give you a sense of TAMs, we were talking about some big ones. So at IPO, Uber said they had a $12 trillion TAM. So you can see how these numbers can get inflated pretty quickly. They were going to do everything for everybody, right? So, but these are where those TAMs come in. And obviously, as someone said, if you're a seller, you want that TAM to be as big as possible and show this great opportunity. There is no limit to what we can do. So Uber came out with that $12 trillion TAM. And I would say, in some ways, TAM is the easy part to do, but it's certainly not sufficient. And in many ways, really not that helpful from a standpoint of decision making. So as we go from TAM into our serviceable addressable market, so that's really the SAM, and Brian talked about this a little bit as well, as they look at their investments, what are those hills that you need to climb, or what are the constraints or barriers kind of holding you back today? So is it a geography? We're only in one region. Is it a certain technology that you only support? Is it certain segments or markets? So we only work in the food and beverage industry, but right now we only work in brewing, but we want to expand. So there's a variety of different constraints that you're going to have on your market. What is really serviceable or addressable for you as an organization with what you have today and what you're planning to really be able to address that TAM? In most cases, what we see is the SAM is very much smaller than the TAM, right? So you've got this really big TAM, you want to get to it. But today, given our geographic constraints, our technology constraints, we're only in healthcare right now. We eventually want to get into fintech. Great, but here's where you are today. Here's where those limits are. There may be also behavioral constraints. I think, Bruce mentioned telemedicine. It's another great one, right? The technology was there. We could deliver it anywhere, but behaviorally, we just weren't there yet. The physicians and patients weren't really ready for it. So I think an important part of SAM is really understanding what are the constraints that exist in my market today? What are the barriers to me really addressing all of that? And then the flip side of that then is what are the drivers or trends that may overcome some of those barriers or constraints? Unfortunately, a pandemic was a key trend and driver for telemedicine, but these are the things we're looking for really as an analysis around SAM. So this is how big TAM is. These are constraints. What might overcome those constraints? What can we do to drive some of those? And at the end of the day, I think you really end up with some really interesting growth strategies and roadmaps and priorities. Like if we do this first, it'll get us this part of the TAM, then we can go there. So we continue to kind of think about what are those different hills or steps that we want to take to really start overcoming some of those barriers and constraints. And obviously, the more we can use the trends and drivers that are in the market, the better. And if you think back to Uber again for that $12 trillion TAM, when they first started, they were really limited by geography, right? They were in New York, they were in LA, they weren't in every city, they certainly weren't worldwide yet. They were limited to technology. They only had smartphones. If you didn't have a smartphone, you couldn't use Uber, and smartphone penetration wasn't as strong. They really kind of went after that black car segment first before they really kind of went after the taxi market. So again, they had this big TAM, but they had those constraints, limitations, but they knew trends were in their favor. More and more people are going to be developing and using technology on smartphones. Geography, that's just money, start going to these different segments. So they really started removing a lot of those barriers and even found new ways to access their assets by going into food service. We got into scooters, which they have gotten out of since, but continue to remove those barriers to add more and more of that serviceable addressable market. So really, it does get to that conversation, and as both Brian and Soma talked about, that decision around growth versus profitability. Can we remove these barriers? Can we do it profitably? Is it really going to be a big enough opportunity for us to continue to move geographically or technology-wise, whatever it might be? And obviously, the big part of SAM too is that it is dynamic. Brian mentioned that in the board meetings, right? It's not static. It's not here's what it is today, and it's always going to be that. As we remove barriers, trends, competitors come into the market, all these things are really going to start changing that SAM and probably change our priorities and our roadmaps as well. Where are we going to invest? Because what's going on externally is certainly something we keep a close eye on. But I think as you're talking to, whether it's a potential acquirer, growth equity, or even just internally developing strategies, this understanding of the SAM and what those barriers are really going to be helpful as you start moving forward. Then the last piece is kind of the SOM, or what is our share of market? So given these barriers we have, given the market we can currently address, how are we going to win? So what is our value prop relative to the competition? How are we differentiated? What is going on in there? And I think Soma and Brian both talked about that. So we might have a great TAM, have a really identified SAM, but it's highly competitive. We're not that well differentiated. So we really have this challenge now of what is our share going to be? And Bruce, to your point as well, if it's billions of dollars and we're going to end up with a couple of percent, it's not really that interesting. So how do we really understand that value prop, competition, differentiation that is also going to feed into things we're doing? And obviously pricing fits into that. Someone mentioned pricing power. So these are all the kinds of things that we kind of drill down from that enormous TAM that we have to, what is really addressable to us today? How do we continue to increase what's addressable? But most importantly, how are we going to win in the segments we're playing in? Because you could open up a lot of new markets, right? But if you're not winning anything in these new markets, it's just a waste of capital. So that's kind of the way we think about all these different components of TAM to SAM to SOM, but really trying to drive decision-making, really helping operationally. How do we grow the business?
Terrific. Heidi, I think we had a couple of audience members that wanted to participate. So Sumit, did you have a question or wanted to have a point that you wanted to make?
Oh, sure. Yeah, I wasn't expecting to be able to speak, but I appreciate your guys' attention, and thank you for having this call. It's been helpful so far. So I'm in the position, and it's very hard to put a number down as far as what my TAM actually is. As we started this thing, TAM was not even on my radar, but as we switched over to a SaaS model and started changing the genetic makeup of the company to a SaaS model, the opportunity has really started to reveal itself. And so I guess really my question was, I'm in a position to capture a majority of say of what I know to be a maybe $150 billion TAM, but there are, I think to Bob's point, there are related, not even related verticals, right? Uber wants to do everything. They want to delivery and taxi service and everything, but there's also within the same context other verticals or other services that I could provide that kind of, if I have a bag full of services, it's very likely that they go for 2 to 5 of the products instead of just one product. So I guess it's for us, or for me right now, in giving an accurate SAM versus a TAM, right? Giving an accurate SAM, I guess it's, how do I strategize that? Do I just go for the whole big home run and hope that, Brian looks at me not like I'm crazy, or what do you guys think is the best approach?
Well, Bob, why don't you start it? Do you have enough information there, or do you need anything
Sure.
else from Cigniti?
I think it is the, kind of age-old question, right? Because we want to show a, sizable TAM, because we want to hit, those benchmarks that Soma and Brian mentioned. We want to show how big it is. But if it's not defendable, then I think you quickly lose, the confidence of those folks you're talking to. They're just not going to be believing. Like, there's no way you have a $150 billion TAM. This is ridiculous. So I think you really need to understand what those, if you will, even components of TAM are. Like, here's this piece of TAM we think we can address. We think we can address this piece and this piece. Maybe not all at once, but I think the challenge is, I want it to be really big because I want to impress everybody. But if it's not believable, then you're not going to get very far in these conversations. So really, you need that work underneath to say, here's why I think it could be this big. Here's what we're going to be doing about it. And it's probably more about the plan of how to get there than it is about the number itself. But I'll let Brian throw a few comments in on that.
Yeah, thanks, Bob. I completely agree. And kind of brings up a couple dimensions that I think don't necessarily map cleanly to the SAM and SOM concepts. And so one of them you just hit on, which is kind of proof points. So I think when you raise capital or when you position TAM, again, addressable is a very loose term. And so, I think you could expand that in any number of definitions and they'd all be correct. But I think where proof really meets pudding is when you have proof points in your customer base and proof points in the business model that show you're absolutely already beginning to access and unlock all of the slices of that TAM that you've identified. Take, for example, a horizontal SaaS platform that currently is selling into home services. And they've identified healthcare and utilities as 2 other verticals that are included in their TAM. They could be 100% correct on that. But I think, when folks are scrutinizing your TAM, they will want to see examples of customers in those verticals and sales velocity and pipeline in those verticals to really take, kind of get that number to feel more real to them. The other part that's kind of I don't think we've really touched on it yet, but I think Bruce's example of telemedicine reminded me of is really, there's addressable, and sometimes there could be a wide gap between addressable and the actual spend, the actual adoption in that market. And at least the way, we tend to think about things, we tend to look at both of those numbers. A lot of high growth technology companies, there's a big addressable market, but the adoption, you're still early on that curve. And so a lot of that addressable market opportunity is kind of untapped. So I think making sure you're looking at those two approaches very distinctly, I think could also bring a lot of value to how to shape the future and direction of the business.
Terrific. Sumit,
Thank you.
does that answer your question? Do you have any follow-up for either Brian or Bob?
No, I think that very well answered my question. Thank you both.
Terrific. Bruce, did you have something else that you wanted to throw into the mix?
Oh, well, I threw in a question, but I'll state it verbally to, I guess, to Brian about, again, TAM could be yay big, and I've seen graphics of kind of a core and expands, but when it comes to, okay, I'm loving this deal, now I'm in diligence. Are you going to third parties? Are you going to the Bob Yayacs of the world to say, hey, write me a report? Is it $1 billion or is it 100 million with landmines? So the question then is, using third parties to do it, are you relying more on management and your own instincts?
It can be a combination of both. I think there's a lot of instances where the TAM is clearly defined. There's a lot of top-down research reports, and we'll spend a significant amount of time talking to folks in our network and subject matter experts to help us construct the bottoms-up approach. And then there are other moments where I think that that information and those kind of that type of data is less available and the market's less defined. And in those cases, we'll certainly work with third-party advisors to help us really kind of arrive to a more specific and very robust view on the TAM.
Great, thanks.
Chris, you're on mute.
Yeah, trying to be quiet there. So Soma, why don't we address the same question to you? In assessing a potential acquisition opportunity, how often are you going to outside third-party resources to help assess the TAM, or is it really the expertise internally at Infor that enables you to do that?
Yeah, like Brian said, it's actually a combination. We have a certain focus markets we are going after, so we do have expertise, but we generally have a third party actually make an assessment in terms of both talking to customers, getting feedback, and also prospective customers and getting feedback, and then assess what's really addressable, right? So yeah, we do use third parties routinely, which augments what we internally know. At least pressure test what we think is the way to go, where this is going to pan out.
Got it. So we've relied on you, Soma, to lend the acquirer's view to this, and certainly it's near and dear to Brian's heart, understanding what someone who's going to by buying his portfolio companies would be looking at. But can you talk to us a little bit about how Infor actually uses TAM, SAM, or SOM in its own business strategy?
Yeah, so we spend my budget, like, so in the product R&D spend, we're spending about 800 million a year, right? That's a lot of money being put into investments. So routinely, when you look at, there's always competing priorities. Do you go to an adjacent industry and try to gain market share there, or do you go deeper in the current industry where you can actually materialize more of the TAM and grow that way, right? So this is constantly being used on a quarterly basis. We look at when we look at roadmaps, the investments in terms of product portfolio management, investment into what we are actually building in terms of innovations. This is a key ingredient to determine like what's really going to deliver better ROI, and also what's going to deliver better value for the customers we serve, right? They are kind of tied together. One of the things that we didn't talk about here is that depending on the kind of SaaS software that you're bringing to market, some have barrier to entry. So like the space we are in, it's in the supply chain ERP market. It's not like a new company can come in and start being in that market tomorrow. It takes years to build that. So that's got a high barrier to entry. So you have a better pricing power if you actually have competitive differentiation. Second is stickiness. What's the switching cost, right? So if you acquire a customer, the cost of acquiring a customer is fairly high in the space we are in. But once you acquire the customer, they're in the cloud, highly unlikely they're going to leave, right? So when you look at those things, when you put your investment dollars to work, you're really looking at, if you're going to penetrate an industry. I think Bruce asked a question earlier, how big is good enough for you to own the market share, right? Being the size we are and being part of Coke Industries, we'll only enter a market if we are going to be in the top 3. Otherwise, it doesn't make a lot of sense for us to participate, right? So can you really do that? So all of those things drive what the roadmap is and how we think about investments. Should we start a new product versus the existing product expansion? So it's an ongoing activity that uses TAM and SAM and SOM, on an operational basis to drive decisions.
Terrific. Thank you. So we have a special member of our audience today. I know Philadelphia is not always known as the hotbed of technology company IPOs, but Vertex is certainly one of the standouts in the Philadelphia area that has had a recent public offering and very successful. And John, I know that you're out there. I hope that you have a moment to share with us maybe your view on how you used TAM, SAM, or SOM in your business strategy along the way, and how it in particular played into the IPO process, if at all.
Can you hear me now?
We can hear you, John. Great, thanks. Thanks for joining us.
Thanks, Chris. So TAM, SAM, and SOM was, as Bob knows, a pivotal aspect of going public. And one of the things that we didn't really touch on so far was, if you're going public, what are you formally going to include in your filings? And so I'm going to try and fill in an area that we haven't covered so far. And so for our point, if you're going including your 10K or putting in your filings, the aspect of the TAM, and particularly a SAM, takes on a new life itself, because you can't just analyze it. You have to basically build a case that's defensible in a court of law. So a lot of meetings with attorneys to pull into that process, to go through the rigor of documenting what that looks like, so that you can go and have confidence that you're claiming that your TAM is a certain size and that you intend to go after a certain element of it, and how you're going to go out and pull it forward. So the rigor of what we're talking about, the data sources that Brian alluded to and Bob alluded to, become almost life unto itself. What are public, what are private? What are you doing that is considered, in essence, IP? How are you going to pull that all in? And basically you work with your attorneys to build a defensible model, so you can walk anyone through the rigor of how you achieve this as you're going public.
Terrific. So in the context of an IPO, you really have a lot of pressure on you to be able to substantiate. It's not just being able to kind of put your finger in the wind and do a kind of a rare evaluation. You have to really dig deep into it. So John, was that a process that was evolving over a long period of time? And as Vertex grew, did it really evolve and change? And specifically around the time that you were going public, had it changed substantially in a relatively short period, or had it been set for a while?
Well, it was a process. I would say it's a process of learning. So you build your initial model, what you think the TAM is, and then you begin to evaluate it and analyze it. And that's where the SAM and the SOM comes into. All right, so that's where you get into more of the debating of what it is and what is possible. Also, when you're moving in, going public, and you have competitors, you have to look at what your competitors are doing and how they're building their TAM and their SAMs. So you have to be defensible on how we're saying versus what they're saying, and pulling all that together. So it's a process that evolved over time. You put basically a hypothesis together. You look at your experience. In our case, our company was very established, so we had a lot of data to pull internally on how the market operates. We've been around for a long time. We also had a very robust ecosystem we could pull from, and then use a lot of third-party data and public data. The other element of it, which you guys touched on a bit, is the dynamism of the market, right? So you have to also take into account trigger events. And some of these give you the sense of range of what your TAM and your SAM could be. So for example, right, COVID. So look at what COVID did to the video conferencing market, right? It accelerated. So there are, in certain markets, regulatory markets, pharmaceuticals, healthcare, there's a lot of regulatory change. And so if you're going to market into that, then you also have to not only look at the market potential, but also the dynamism that's going to come into the market with potential regulation that's going in. So you factor that in perhaps as a potential area for dialogue and dynamism of how you can grow your TAM and then ultimately your SAM. So it's an evolving process, but the main thing is it has to be defensible, it has to be logical, you have to be able to go through your data sources. And so as you go through that rigor, Chris, it will evolve to the point of where you're going public. And depending on how your approach is and your risk, right, will determine on who are you using to review that, right? So in our case, we had multiple attorneys inside and outside the company assisting us.
Got it. Did the evolution of your TAM play a factor in your decision both of whether to go public and when?
It did from the standpoint of whether to go public, right? So you have to look at the potential that you think you could achieve within the TAM. In our case, some of our competitors had TAMs that were larger. We broke those down as the very simplistic models, and we decided, okay, so they're going after this segment of market after analysis, and our segment of the market is going to be slightly different. So you look at that potential, you look at the penetration of that market and the potential that you could achieve in growing into that. So it's critical to be able to demonstrate your TAM and the growth potential within that TAM. So yes.
Terrific. Thanks. Thanks a lot, John. That's very helpful. Any questions for John before we move to the next audience question? Okay, I think so. Our next question really is addressed to both Brian and to Soma because it has to do with valuing businesses. And the question is, do you value a business more if it is second or third in a larger TAM, or would you rather see the number 1 or 2 position in a smaller TAM? So for example, would you rather have the market leader in $1 billion TAM or SAM, or would you rather have someone further down the chain, 2, 3, 4 in a $5 billion TAM? Brian, why don't we start with you on the kind of where you're looking and the investment perspective, and then move over to Soma in terms of the acquisition perspective.
That's a really good question, and a extremely challenging one to answer. You know, being number 2 in a $5 billion market opportunity, if the gap between you and number 1 is not all that great, I think that's a wonderful place to be. We would be highly interested in that situation. You know, being a market leader in a $1 billion market opportunity would also be extremely attractive, especially if you were kind of that there's a lot of daylight between you and number 2. So it's really hard to answer with kind of, you know, that level of detail without really going into the diligence and the underwriting to figure out at the end of the day how much of the $1 billion SAM will that market leader capture versus how much of a $5 billion SAM do we think, you know, the number 2 or number 3 player will capture. I think depending on those nuances, the answer could differ. What we have seen over time, though, is that by and large, just like you see with Uber and Lyft, generally speaking, the predominant market value and share of overall market valuations tend to go towards the market leader as opposed to the number 2 or the number 3. And so that's one of the reasons why when we're evaluating, scouring the market for investment opportunities, we have such a strong bias towards those that we view as being clear market leaders.
And when you say market leaders, are you looking for companies that are currently the market leader, or are you really looking at a company's potential to be the market leader in their particular TAM or SAM?
It's really both. Sometimes, we're fortunate to find companies that are currently market leaders. We have a high degree of conviction they will continue to be market leaders. Other times, part of the reason why we're providing capital is because we are really big believers in a company's ability to define a market and emerge as the market leader. So I think both of those situations apply. Okay.
Soma, can you address the perspective of the acquirer in terms of whether you would rather have the leader in a smaller market or the number 2 or 3 in a larger market?
Yeah, kind of the answer is the proverbial, it depends. But the way we typically look at it is if we are looking at a market leader in a smaller, TAM, that would typically be where we have a gap in our offering. And if this addresses our gap, that the combination of the two actually creates a slightly larger TAM, and then we can be the number 1, then that is very interesting for us. But in general, though, more often than not, if the company is not a leader, but they're actually a number 2 or number 3, we know that means that the product and the company is established. So that's not questionable, right? 2, many times I find that technology companies who are actually coming in second or third actually sometimes have better technologies and they can actually leapfrog, right? That is also very interesting. So I would say I would lean more towards the number 2, number 3, where we can actually make that company be the number 1, where we have that opportunity is more interesting. But on the other hand, like I said, if it fills a gap, a market leader would be interesting as well.
Got it. So Bob, let me circle back to you for a second, just to give us a little insight into counseling companies relative to their TAM, SAM, and SOM. What are some of the challenges that you face when working with companies, and maybe give us an assessment of maybe it's different with earlier stage companies, with later stage companies, but in terms of really understanding and being realistic, because I think one of the things that we heard a lot today was that TAM can mean many things to many people, and there's not often a consensus around it, particularly when a company is either looking both for financing or to be acquired. So in terms of kind of bring that reality before they are met with adversity from either a potential investor or a buyer.
Yeah. So maybe I'll start with the more established company first. I think Vertex is a great example. The company's been around for a while. A lot of great data, a lot of good insight into the market. So really the challenge there was just documenting and being really clear on how we were calculating TAM, SAM, SOM, and kind of working our way through that with John and the team. But we knew what the ASP was for different segments of the market. We could go in and look at what offerings they're buying, we think they should be buying. We could look at the competitor. So those are kind of the easier ones. But I think the most important part, even with Vertex and what John was describing, is really being clear and being able to document and defend those assumptions, because that's really where people are going to push. The math is easy, right? It's really about what are the assumptions that are driving this, and why do you believe this is accurate? As you go down to earlier stage companies, it becomes a lot harder, right? Particularly if they're going into new markets, disruptive technologies, whatever it might be. Those assumptions become a lot more difficult to document because data may not be available. So we're looking for analogs, proxies, whatever it might be, that would help us understand, well, we think this market looks a lot like this other market that's already existing. This is what happened there. We believe our market's going to develop very much in the same way. So we're going to use these kinds of assumptions. And that's where, the conversations get in with folks like Brian and Soma. Why do you believe that? So you're really trying to, again, create that evidence to defend your approach. But in early markets, you really have no great data. So you've got to find analogs or other ways to try to assess that and create good assumptions.
Terrific. Brian or Soma, any closing remarks? And I'll ask the audience before we break here if there's any final questions, but I don't see anything in the chat room. So Brian, maybe a closing thought in terms of companies as they are beginning to position themselves for potential investment, what they should be thinking of in order to attract the likes of a NewSpring.
Yeah, I would just say, I mean, even outside of a pending or near-term investment round or liquidity event, I think there's just a tremendous amount of value in terms of going through the process, the continuous process of developing a TAM, how it's segmented across regions, across end markets, across verticals. Looking at TAM as not a static number, but really a dynamic number that has a lot of different layers to it, and really just kind of going through that exercise of how and where should you focus on unlocking those opportunities. I think there's just as much, if not more, operational benefit, I think, to companies. And when you do ultimately have a transaction, whether it's a growth raise or an exit, that command of those, of the market is really going to bear a lot of fruit.
Great. And Soma, I'm assuming you would agree with Brian, given that you told us earlier that Infor itself continuously uses these metrics in evaluating its own business operations and strategy. So any final comments?
Yeah, no, I 100% agree with that. This is not a one-time exercise. And I think Bruce said earlier, the market is evolving, like telemedicine as an example. When the markets, so you got to keep your ears to the ground to really see how the market is evolving. That actually has an impact on your addressable market and how you tweak your strategy to capture that market. And also the market itself, that evolves over time. Customer preferences and things that drive your TAM to be more dynamic, to Brian's point. So this is something that you should establish as a discipline and do that, say every quarter, that's how we do it. Every quarterly, we revise and look at how the market is evolving, how we are performing. Our win-loss dictates how we can capture more of the market. So it's a very dynamic thing, and this is a discipline that needs to be in the organization as a matter of practice, operational practice, versus you do a one-off exercise to address a particular event, like an exit event or whatever, right? So I think that's Brian's point, and I completely agree with that.
Terrific, thank you. First, I want to thank each of our panelists, Soma, Brian, Bob. Thank you for participating today. This was a terrific and informative presentation. And I also want to say thanks to Bruce and to John for being willing to chime in from the audience. Your participation and input was very valuable. So Dean, thanks for the opportunity to host today. Always a pleasure. And I'll turn it back over to you.
Chris, many thanks to you and the whole team. Just some terrific insights. It's not often that we can delve into so many good and deep questions around a topic that's so important, to the investment community, to growing companies. And again, just grateful for everybody's participation here this morning and all that you're doing, really on the front lines of entrepreneurship. And so with that, I'll send you off for the rest of the day and the weekend. And thank you for your ongoing support and participation here. And again, recognizing our sponsors of this SaaS Roundtable series. Again, it is a series, so watch out for the next one. Boomi, Cigniti, ORS Partners, SAP, SEI, and Troutman Pepper. And by the way, just to put another plug, we in 2 weeks have our PACT Capital Conference, our 28th annual, where we'll have 45 companies presenting, a big gala celebration, which Chris will be sponsoring once again for possibly the 28th year. And really excited about that event. Our registrations have been really flying. Vaccinations are required, and we hope to see you there. Have a great day, all.
Thanks.
All right, thanks, everyone.
Thanks, everyone.